All right, so this is going to be, I think there's probably going to be 3 more lectures on this subject. So we're in the middle of receivables here. Today we're going to be talking about, or in this lecture, we're going to be talking about bad debt expense. And then we're going to have a different lecture on probably short-term notes receivable, and then one on long-term notes receivable. And that'll wrap up the semester for my class. But hopefully these aren't too long. This one might take a little longer than 15 minutes. We'll kind of see, but hopefully we make it through all right. So we'll kind of jump into it here. So, whenever we think about extending credit and we have receivables, what is the main problem? So whenever we have this extension of credit, even for, 30 to 60 days, what's the main issue that we might have? And the answer is a lack of collection. Somebody won't pay. So anytime you extend credit, the biggest risk there is that somebody won't pay. And so when somebody doesn't pay, we call that a bad debt, or sometimes you'll see it referred to as a credit loss. So bad debt, credit loss, kind of synonymous things. And so, basically this bad debt expense, this cost of extending credit, that is something we do need to record. But I want to be clear, it's not like we reduce the revenue. Essentially, you record the revenue. And then later on, if we determine that we're not going to collect, then we call that a bad debt expense. It's a different number on the income statement. It's in a different section. We'll kind of go through all that, but we do have this separate account called bad debt expense. All right. So again, whenever we are in this situation, we really don't know who is and who is not going to pay, obviously, because you wouldn't sell to them if you knew they weren't going to pay. But we do know that on average, some people won't. And so even in a business-to-business environment, some customers won't pay for various reasons. And so we got to figure out how to handle that. Now, what can you use? So you can use historical experience. You could use the credit risk of the certain client. There's lots of things that could go into estimating this. But the reality is there's going to be some error. So you can estimate it, but you're never going to be perfect in your estimation. The only time you really know is when somebody doesn't pay. And so anyway, whenever you have measurement error, obviously there's going to be some corrections and some things you're going to have to deal with. And we're going to kind of walk through all of that. But there are really 2 methods for handling bad debt expense. One is the direct write-off method, and the other is the allowance method. So I want to be clear, though, the allowance method, and this is one we're going to spend most of our time focused on, that is what we use when we're following GAAP, other than a few specific situations. All right, so let's at least highlight or quickly walk through the direct write-off method. So it's very simple. It basically means whenever you determine that a customer is not going to pay, you record the bad debt expense at that point in time. And so what's the weakness of this? The big thing is a balance sheet. So essentially, you're carrying a receivable that in other words, if I have $100,000 in receivables and I know 5% of them are never going to be collected, well, until I write something off, I'm kind of overstating my receivables because in reality, if the asset is supposed to reflect my expectation, and I have 100,000 in receivables sitting there, that's really not my expectation. My expectation is 95,000. And so I really have overstated my assets until we write those accounts off. But of course, now there are going to be new accounts right behind that. And so at all times, your balance sheet is overstating your receivables. At the same time, your net income is going to be overstated, or at least I would say misstated in certain periods, because the cost of non-collection really was incurred at the time of the credit sale. So I might have a credit sale in one period, and then I might determine that someone's not going to pay a year from then. And so now I have a mismatch between when the sale took place and when I record the cost of the credit that I extended. And so that mismatch, it can be a problem, especially if your variance is great. So if in one period you have high collections, the next period you have low, you get this mismatch. Or if you're growing, like if your company is growing in revenue, then you're always going to be kind of lagging behind recording that bad debt expense. And so the bottom line is that you have usually your net income is going to be overstated for a normal company, and that your balance sheet is going to overstate its receivables. You can use this approach if it's determined that bad debts are immaterial. And so it's an approach that is acceptable only if bad debts are immaterial. So very quickly illustrating it, $30,000 of goods to a customer. They went bankrupt. They know they're not going to pay. And so on April 24th, they finally record the fact that, we're not getting paid. And so the way we do that is we debit bad debt expense. Again, this is the direct method. We debit bad debt expense. And of course, we take the receivable off of our books. And so, sorry about that. And just to highlight, just as a reminder, bad debt expense is an expense. So it's going to be in the 500 series. And then we keep moving on there. So essentially you take the receivable off your books, record the bad debt expense, and off you go. Now, here's what I wanted to highlight though, is that the sale took place on November 1st of 2021, and the write-off took place in the following year. And so really what you have is you have income being overstated in 2021 and kind of indirectly being understated in 2022, as far as just for this particular customer. And so that mismatch is the downside of the direct write-off. But if this company had $1 million in sales and this is the only account that was bad, I mean, who really cares? It doesn't really matter. But in other cases it could matter. And so we are going to spend most of our time on the allowance method. That is the method that under US GAAP you must follow, again, unless your write-offs are immaterial. But what it is you estimate ahead of time. So rather than waiting to record the bad debt expense when you write something off, you calculate your bad debt expense using an estimate. And that estimation creates this additional count called the allowance for uncollectible accounts. I've also seen it called allowance for doubtful accounts. But essentially what it does is it says, okay, I have my receivable, and that's the gross amount. Let's again, back to our numbers, we're 100,000. So somebody owes me 100,000. I estimate, or I believe that 5,000 of that will never be collected. And so what you end up doing is usually through the adjusting process. So like as an adjusting entry, you'll put in 5,000 as an allowance against that $100,000. And so the net amount would be 95. And so that allowance account is a contra asset. And so it's coupled with the receivable and gives you sort of like a net receivable. And so we'll talk about how you calculate that, but that is what that account is. It's a contra asset account. It's coupled with the receivables so that when you report on your balance sheet, your gross receivables less your allowance gives you your net receivable. All right. So again, now that net reflects what we expect to actually receive. So 100,000 minus the $5,000 allowance gives the financial statement user insight into what you actually expect to receive, which is 95,000. So when do we record bad debt expense? With the allowance method, we know with the direct write-off method, we record the bad debt expense when we actually wrote off the account. So under the allowance method, it is a little bit different. And maybe it kind of helps to start by thinking about, when it's not recognized, keyword not. It is not recognized when a specific receivable or when specific receivables are written off. In other words, it is not like the direct method. So when we write off an account, that is not when we record the bad debt expense when we're using the allowance method. Instead, with the bad debt expense, we recognize it in the same period that the credit sales were made. So we do some sort of estimate to record it in the same period where those credit sales were actually made. And so again, like I said, it is part of the adjusting process. And so we'll kind of walk through how that happens. All right. So began operations in 2021. They sold 12 million on account. They had collected 8,950,000 during the year, which left a balance of 3,050,000 in accounts receivable on 12/31/2021. And so when we think about our receivables account, initially, obviously, we started with a balance of 0 because it's a new company. And then during the year, this would have been, through however many transactions, we would have continuously been debiting our receivables. And at the same time, as we were collecting, we would have been crediting our receivables. So those would have been like an ongoing thing. I bill, I collect, I bill, I collect, I bill, I collect. That process just would have continued. And so what ends up happening at the end of the year on 12/31/2021, the balance in our receivable is $3,050,000. So this is kind of what's going on within that receivables account. And so this T account just illustrates sort of the dynamics of what was going on. And so with the allowance method, what we're going to do is we do an adjusting entry. And so we're going to get to how we got the number later, but for now, we'll just say, hey, listen, they did a calculation and they figured out, well, we think that out of that $3,050,000, that $250,000 is not going to be collected. So in other words, my expectation is that I'm only going to receive $2,800,000 instead of the full $3,050,000. Again, we'll get to how we do this, but for now, let's just say that's what happened. We went through, we looked at our receivables and said, you know what, in reality, I think we're probably only collect 2.8 million of this, which basically means that we have this $250,000 allowance. And again, the allowance is meant to go from the gross receivable amount to what we actually expect to receive, or that's the net receivable. So if I have a gross amount of $3,050,000 and my expectation is $2,800,000, it means there needs to be an allowance of $250,000 for bad debts, or an allowance for uncollectible accounts. And so that journal entry, whenever we determine that $250,000 is the allowance that we need to make, is the bad debt expense in this case, we record the bad debt expense of $250,000. That's the debit. And in this case, now we create that allowance account, the allowance for uncollectible accounts. Notice that it's in the 100 series. It is an asset, but it does have a credit balance. So it is a contra asset. All right. So now when we report this in 12/31 for the year ending 12/31/2021, our sales revenue is 12 million. That's not affected by this allowance method. And then way down in the operating expense section, now is where that's where the bad debt expense would show up. It shows up in the under operating expenses. And so the top line revenue is not affected by this estimation. Instead, the bad debt expense shows up in our operating expenses. All right, then on the balance sheet, again, we have the gross amount of receivables, and then we have the allowance, and then we have our net. Now, typically speaking, they're going to be reported sort of together into one number. And so if you remember in chapter, I forget which chapter, I think it was chapter 4 maybe. In chapter 4, we had like an indentation where we had receivables, and then we had the allowance, and then we had the sort of the net reported out on the far right column. And so this is an alternative way of presenting that, and it's actually the more common way of presenting that, where instead of having like the accounts receivable and then the allowance like sort of right below it and sort of in a middle column with the net being out to the right, instead what we do is we just combine it all into one line and report that net. But notice that we say it's our receivables, and we say net of allowance for uncollectible accounts of 250,000. So that extra disclosure allows the user to determine the gross amount and the net amount. And so now if you do it in 2 lines, that's also fine. So either one is fine. This is just sort of efficiently kind of putting them together. And again, instead of having sort of that middle column with the net out to the right, they're just kind of combining it into one. But essentially, you do report ultimately, under our current assets, we report the net amount. And that measurement, that 2.8 million, is called the net realizable value. So again, that's the amount that you expect to receive. So then further on down the line, at some point, let's say in the future, we have this $30,000 account that, you know, again, they went bankrupt. Now we're going to write them off. Now before, with the direct write-off method, we had the bad debt expense and we took the receivable off of our books. Now, again, in this case, remember, it's a little bit different because it's not about recording the bad debt expense at this point when it goes uncollected, because we already estimated the bad debt expense. And so we're not going to now record bad debt expense twice. And so what we end up doing is, again, we take that receivable off of our books, but instead of debiting bad debt expense, we debit the allowance. Because really the allowance is our estimate of future accounts that we're not going to collect. And so if I think overall 250,000 aren't going to be collected, and now all of a sudden 30,000 goes uncollected, really what it means is there's really only $220,000 left that I don't expect to collect from those 2021 sales. And so really that's kind of the idea is I've already recorded the bad debt expense. Now I've set that expectation. Now I'm going to adjust that expectation as I write accounts off. And so thinking about the T accounts at the end of the year of 2021, which is also the beginning of 2022, I had my gross receivables of $3,050,000, and I had my uncollectible accounts of $250,000. So I'm sorry, $3,050,000 and $250,000. Now, obviously, there could have been some collections in here, but we're kind of ignoring that for now. But when we record this bad debt expense, the receivable comes off my books. So we're going to credit the receivable $30,000, and we're going to simultaneously reduce our allowance account. And so then the new net for each. So on 4/24/2022, the net or the gross receivables are now $3,020,000, and the allowance account balance is $220,000. All right. Hopefully that makes sense. So now the next question. So that's the journal entry when we actually write something off. So what do we do then? What happens with the income statement? So how does this entry to record the bad debt, bad debt? I should probably have said that differently, not bad debt expense, but bad debt affect the income statement. So in this case, there's no effect, because if you think about the two accounts, they're both assets, right? So there's no effect on the income statement when we actually write off the account. So there's no effect there. What about on the balance sheet? Well, the interesting thing is that the net has not changed. In other words, the net realizable value is 2.8 million, and it was 2.8 million before. The difference, though, is now the allowance balance is 220,000, right? So the reality is the net realizable value is unchanged when you write off an account. But what does change is, of course, is the gross receivable, the balance went down, and the allowance went down for the same amount. So it's like you started here and they both moved down together. So the difference is still the same. And so that there's no effect on net assets whenever you write off an account when you're using the allowance method. All right, so what happens then when all of a sudden that person you thought was never going to pay, they turn around and they actually pay you? And so we have to reverse it. And so now how do we reverse that write-off? So the first step there, of course, is to bring the receivable back onto our books and to readjust our allowance account. So basically we unwind the previous write-off. So the write-off was a debit to the allowance and a credit to receivable. To reverse that, we debit the receivable and we credit the allowance. So now we're reversing that. And then the second step then is, of course, you actually record the receipt, because the reason why we knew they were going to pay is because they actually paid us. And so then we record a debit for the cash and a credit for the receivable. So it's sort of a little two-step process. All right, so now let's figure out how we actually calculate this stuff. In other words, I just gave you an amount, 250,000. The question is, where do we come up with that? So what are the different approaches that we can use to estimate that allowance account? And we're going to start with the balance sheet approach. And so the balance sheet approach basically is you look at your assets, and then you estimate what the balance in the account should be. So you look at it, you say, okay, what should the balance in the allowance be? And then whatever entry I need to make, that will kind of tell me what my bad debt expense is. And so we're going to use the allowance method, the allowance for doubtful accounts or allowance for uncollectible accounts. We're going to use an inferred balance in order to back in to the bad debt expense using this balance sheet approach. So how do they do this? How do they figure out what the balance should be? They use what's called the current expected credit loss model. And essentially what it does is you say, okay, well, there's really no one method to do this, but basically you have to kind of reasonably bring in all kinds of things like historical experience, current conditions, forecasts. And so you use this information to say, okay, based on this process, this method, and you should use the same method every year, but that method that you're going to use, however you forecast it, you're going to say, okay, this is what we expect. And so that current expected credit loss model doesn't specify exactly how you need to do it. It just says that you have to use all the relevant information in order to develop an expectation. And once you have that expectation, then you kind of press forward with that. So how could you do this? Well, you could look at every single customer account, right? And so, or you could kind of look at aggregations. You could look at, there's lots of different ways that you could do it. Again, there's no specific way, and every company has their own way of doing it. But basically, you need to have a method that is reasonable, that is repeatable, that makes sense historically and given current conditions and all that kind of stuff. And so let's just kind of think of what we're going to do is we're going to look at different accounts and kind of think through this. And rather than sort of, our approach is going to be kind of looking at an aging table. And so what an aging table does, and that's what we're going to focus on in this class, is it classifies accounts by their age. And so you can see that, our one of our customers, Axel, they have some sort of receivables that are in total 20,000. Some are, within 60 days, but some are a little bit older. And then we have Banner, they have 33,000, but look, theirs tend to be a little bit older. And then you have Dando, and there's, kind of like Axel. And then, bunch of different companies, right? You have all your different companies and all different levels. And so, until sort of, if you added it all up, we would have like, okay, our total receivables at this point in time, 3,450,000, of which most of them are, pretty new. But there are some that are a little bit older. And so one approach would be, well, let's just take Axel. Let's just look at them. What do we think about them? That'd be one approach. Another approach is look at Banner and say, okay, well, we know Banner and they're usually slow on paying, but they always pay. That would be something you could do. We're going to be a little more agnostic about the customer. Instead, we're just going to look at the different ages and say, well, as the receivable gets older, the probability that they won't pay goes up. And so you have this trade-off between, the older it gets, the more likely it is that they're not going to pay. And so we're going to use that aging process in order to develop our estimate. All right. So again, the aging table is going to look at the balance and kind of calculate it as follows. But I want to be clear, remember, we're calculating the balance for the allowance for doubtful accounts. That is what we are calculating. And so then we have these different age groups, 0 to 60, 61 to 90, 91 to 120, and over 120. Obviously, every company could have their own way to break it down. This is just the way that we're doing it. And so when I subtotal that out, these were the different amounts on the previous chart for each of those types or each of those age groups. And so as we would expect, as they age, the probability that they don't pay or the probability that they don't get collected goes up. So, ones that are fairly new, we're pretty sure we're going to collect them. Like 95% of the time we're going to collect, which means 5% of the time we're not going to collect. But notice now, as you get a little bit older, those that are over 120 days, we're basically saying, listen, there's a 40% chance these people are never going to pay. And so what that means is within each of these categories of receivables, there's an estimate of how much we won't collect within each category. And then we add them all up, and that gives us the balance. So it's saying, okay, based on our receivables at the end of the year, what we report on our balance sheet, this 270,000, this is what basically we do not think we're going to collect. 270 could end up being higher or lower than that. We don't know, but that's our expectation. So we expect that we will not collect $270,000 of our receivables. And so how do we use that information? We use it in our allowance for uncollectible accounts. Now I'm going to show you how to do this using a T account. I think it is easiest to use the T account. It's not like GAAP requires that you do so, but for me, this is the easiest way to understand it. And so again, what we're doing here is we're just going to assume that nothing really happened in 2022. In other words, there really weren't any write-offs or anything like that. So we had that one write-off in 2022, and then we're going to assume nothing else happened in terms of write-offs. And what that means is, that account balance was updated to 220,000. And now, all the way to December 31st, that is still the balance. We haven't touched it. So now what we do is we say, okay, well, we just calculated what we thought the balance should be. And so we put that information into the T account. That's where the 270, this came from that calculation in the table. This was the pre-adjusted balance. And then this is what we calculated in the table. And so really the question is, well, how do I go from a $220,000 credit balance to a $270,000 credit balance? And this is the journal entry that we're trying to figure out. This is the journal entry that will get us our bad debt expense. We need to make an adjustment to this account. that adjusting entry is where we derive the bad debt expense. And so that plug amount, that $50,000, that is the bad debt expense. But notice it impacts the allowance account, right? So this is an entry in the allowance account. In other words, I need to make a change to my allowance account. And since I need to make a change to my allowance account, of course, that's going to be a credit. You can see that right here, the T account. We're going to be crediting that account. And so the debit then ends up being the bad debt expense. So then we take that information into the journal entry, we debit our bad debt expense, we credit the allowance, and now everything is up to date. So now in our journal, the entry has been made in order to get the allowance for doubtful accounts balance to $270,000. And that is the way we get our bad debt expense using the allowance method, which is the balance sheet approach of the allowance method. All right, so let's kind of let's throw some wrinkles in here. So let's say that there had been additional write-offs. So before, remember, we assumed that 220,000 was sitting there and we didn't have any more write-offs. Let's say that for whatever reason, we had a bunch of write-offs in 2022, so much so that we ended up with actually a debit balance in our allowance for doubtful accounts. In other words, we would have had another $320,000 of write-offs. And that large amount of write-offs actually created a debit balance in our allowance for uncollectible accounts. Still same aging table, nothing changed there. So the post-adjusted balance still needs to be $270,000. And so now the question is, how do I go from a $100,000 debit balance to a $270,000 credit balance? Well, the only way we can do that is through a $370,000 credit. And so that is the journal entry. So we will credit our bad debt expense we'll credit the allowance for doubtful accounts 370, and we will debit the bad debt expense 370. And so basically if you kind of think about it, what ended up happening is we kind of underestimated the write-offs in 2021. We did that. We underestimated it. And so the underestimation in 2021 kind of created a bubble where now we're going to have a higher bad debt expense in 2022. And so that's whenever you overestimate, it kind of affects the following period. All right. So an underestimation in the current period is going to lead to a higher bad debt expense in the subsequent period, and then vice versa. If I underestimate in the current period, there's going to be or if I overestimate in the current period, then I'm going to have a lower bad debt expense in the subsequent period. So it all kind of balances out over time, but any error in your estimation kind of flows into that next year, and that's what we saw here. All right. Now, there is this other approach called the income statement approach. It's not very common to use because basically it says you can use this only if the ending balance is accurate. Well, how do I know if the ending balance is accurate? I probably have to do the balance sheet method, balance sheet approach. So all of it to say, this is another way to do it. And so we're going to at least illustrate it very quickly. So let's say credit sales of 16,000. And really in their experience, if you have credit sales of 16 million, you're not going to collect 2%. And so that's kind of their prior experience. They think it's about 2%. And what does that mean? Well, it means that, okay, well, our bad debt expense really should be about 300, based on our credit sales in 2022, the bad debt expense should be about 320,000. And so you just throw that into a journal entry. So you debit your bad debt expense and you credit your allowance for 320,000. So again, it's more of a direct estimate rather than using that balance sheet aging table and all that kind of stuff. And so again, we would take that journal entry, and then in our T account, our allowance account, we add the 320, and now we're up to 540. And so for me, this would seem kind of pretty out of whack. But remember before, what if we had the 100,000 sitting over here as a debit? If we had a 100,000 debit and then a $320,000 credit, we'd end up at 220, which that wouldn't have been too far off. And so, in this case where we had underestimated in the prior period, using this method really would have overstated our allowance. And so it's unlikely they could have used the income statement approach if they had only had $30,000 of write-offs. If they had 320,000 more in write-offs, then maybe this would be an acceptable method. Again, much easier, but much less commonly used. All right, so that is it as far as the bad debt expense. I'm not sure exactly how long that went, but kind of wanted to get on there. So now we're going to jump into notes receivable. I'll probably do short term in one lecture and long term in the other. We'll see how long it takes. So we either going to have one or two more, and then that'll be it. All right, have a good one.